Hello, everyone. Welcome to our session today. 8 factors to consider before business registration. Right? Yeah, the reason why we want to record this session, recently we have quite a few new clients, and the main purpose for them to come to us is actually they're considering to register a new business. Okay, so we recorded other sessions before, but we thought we'd just do a quick recap. Okay, before we go to the main content, a quick declaration. The information provided is for general guidance only. We recommend consulting a qualified tax advisor or planner before implementing any tax planning strategies. All right, now let's have a look. To make it easier, this time I actually prepared a little table here. All right, so the first 4 factors we consider, they're mainly falling in key business structure differences. Okay, so basically, okay, legal structure for sole trader, there's no separation between the ownership. The person or individual taxpayer is a sole trader. There's no separation. And then partnership is also not a separate legal entity. Yeah, basically 2 or more people share the ownership. And company is a separate legal entity, and trust is a separate legal entity if it's managed by a corporate trustee, basically. All right, then liability, sole trader is unlimited, so very risky. Yeah, so if the customer was to sue a sole trader, then the sole trader's personal asset will be exposed. All right, and that's the same to partnership. So partnership is actually more even riskier, okay, because different partners can separately sign agreements or business deals behind other partners, and then they can still represent the full partnership. So then that's potentially causing more risks. Yeah, even some partners don't even know, and then they're already exposed to the risks that's actually brought to the partnership by other partners. Okay, and then a company actually better protection because the risk is limited. Okay, so personal assets are protected, but of course, here is only a top level summary. Directors are still personally held liable if on some rare occasions, if they're, for example, if they're trading insolvently, okay, the company is already insolvent, they're still trading. And then if they're all they owe tax office, PAYG withholding tax, or employee super, then potentially their personal asset will still be exposed. All right, and then trust is limited if there's corporate trustee. And then that's why I mentioned here, it depends on the trust setup. Okay. Control. Okay, sole trader have full control over decisions, of course. Partnership is shared control. Okay, so also put potentially to disputes. Partnership is actually one of the structures that's leading majority of the business disputes. Okay, one of my commercial lawyer friends mentioned to me that if we want to introduce more clients to them, set up more partnership. Yeah, because of that reason, normally when new clients come to us, they want to set up partnership, we have to give them more information. Okay, how risky a partnership can be. Okay, so be very careful. And the company, so directors manage on behalf of the shareholders. Of course, the shareholders can make decisions on which directors they want to nominate, yeah, to manage the company. But once the directors are nominated, they are managing the company. Okay, basically. And then trust is a trustee. Trustee manage according to the trust deed. That's why the trust deed is critically important. All right, if it's a corporate trustee, then it's trustee directors managing the trust asset. All right, and then next factor to consider, complexity. Okay, sole trader is very simple. So of course, in this factor, the behind the complexity, what you are considering is actually the cost. Okay, the cost of an accountant to help you to manage the related tax return or compliance requirements. Sole trader is very simple and low cost to set up, also low cost to manage. For a return, it's just a simple section, a section of the individual tax return. So it's very simple, also low cost. Partnership could be more complicated. Okay, it actually requires a partnership agreement. So partnership need to lodge a tax return by itself and then record how much profit is distributing to each partner. And then the partner actually need to lodge tax return accordingly on their individual tax return. So it's a little bit more complicated than a sole trader. Okay, company structure is very complex. Okay, and then it also must register with ASIC. The related compliance requirements with ASIC, with ATO, will be more complicated. For a company tax return, a financial statement, set of financial statements have to be prepared. All right, and then of course we have to go through all the accounts and have a look at the profit and loss statement, financial statement, or balance sheet as well. And then there are Division 7A requirements for company structure. So there are more complicated tax law requirements. And then also because of that, okay, the company return will be much more costly than a sole trader. Yeah, so sometimes it's quite a common question. Client asks me, oh, it's actually quite a simple structure. I use a company structure. How come my cost is so much higher than my friend who's running under sole trader? This is the reason why the structure is different, and then the underlying compliance requirement is very different. Okay, tax planning strategies will be quite different as well. There are multiple deductions that's allowed by a company, but not allowed under sole trader. Okay, trust is most complex. Okay, required legal trust deed. The trust deed is critical, super important for a family trust. So for both company and the trust, it's actually very important that you have the correct initial documentation. Okay, for company structure, it's a constitution, and then the trust is a trust deed. They are the most important documents for compliance requirement and also for future planning, tax planning, asset protection, succession planning, and estate planning. So they are the critical governing documents for the structures. If the initial document is not correct, it might be limiting your future planning strategies. Okay, so say for example, with the trust deed, we normally have the standard version. I think it's more than 40 pages. Occasionally, we have a new client maybe bring a family trust that's registered with a very cheap platform, paying for $300 or less. It might only have 10 pages. Then there are a lot of areas that's actually not covered. That's actually risky and limiting your future strategies. Okay. All right. And then the other four factors you have to consider is more focused on tax related and the profit distribution side. Okay, so suitability. Okay, and then taxation, of course, tax for a sole trader is taxed as personal income. Okay, one section of your individual tax return. So basically, it's charged. The tax rate is your top marginal tax rate on top of all other income. So it could be quite costly, okay, the tax. Partnership, each partner tax on their own share. Okay, company tax 25% for base rate. Company, generally small business entities, 30% for big organization for non-base rate companies. Big organizations or companies generating passive income. Okay, and then trust, beneficiaries taxed on distributed income. So the trust, we need to prepare financial statement. Okay, so prepare a trust tax return. But in that tax return, the trust doesn't pay tax by itself. So we need to calculate, or based on the distribution resolution, okay, how much is allocated or distributed to each beneficiary, and the beneficiary will pay tax on their own income. Okay, and then profit distribution, that's the next factor. So for a sole trader, all income goes to you, or basically the individual taxpayer. Okay, partnership can be split between partners. company retained or paid as dividend. The dividend, one important point here is there will be a franking credit attached to the dividend payout. That's quite commonly forgotten, okay, sometimes by tax agents. So that's actually an important tax planning strategy as well. The company tax paid on the company level can potentially be refunded, okay, in the individual taxpayer's hands. Okay, well, of course, it can be used as a tax offset if the individual taxpayer is actually earning an income below the tax-free threshold. Potentially, the company, the franking credit, okay, attached to the dividend, basically, the company tax paid before can be refunded to the individual taxpayer. Okay, and then that's quite a different, something like a key difference between company and other structures. Okay, trust is distributed as per trust deed. Okay, that's why the trust deed is so important. Okay, what's classified as profit? Okay, also income streaming was how do you stream franking credit? How do you stream capital gain? If you don't have the related clauses in the trust deed, you might be losing the benefit of running a trust. Okay, or utilizing a trust for the as the main structure. Okay, next factor, continuity. For sole trader, it ends when owner stops. Okay, when basically stop the running the business, or if the sole trader, the individual taxpayer, was to pass away, right? Then the business will stop. Okay, partnership ends if a partner leaves, unless agreed otherwise. Okay, it's actually very complicated when a partner leave a partnership. There were very complicated tax calculations. Okay, and then company, it continues regardless of ownership changes. So the shareholders can be changed. Okay, the directors can be changed, but the company will keep going. Okay, that's actually in terms of succession planning. Potentially it can be easier. Okay, you can change the director, you can change the shareholder. And then of course it can only stop if you deregister from ASIC. Okay, of course, there's a complicated deregistration process. Yeah, before you can do it, after you pay all your taxes and everything. All right, and then trust continues as long as the trust is valid. There are vested rules, normally 80 years, depending on which state you register your trust. So this is something important as well. Yeah, check on how many years you can run this trust. Okay. And then what's the best for? Okay, what type of business is the best for different structures? Okay, so for sole trader, maybe freelancers, small businesses, sole operators is easier. Or when you're sometimes when your taxable income is kind of low, okay, so you're not paying a lot of tax. When it's higher, when your asset or underlying asset is becoming more, you should start considering other assets such as a company or trust with a corporate trustee. All right. Then what's a partnership is best for? Is for small businesses with multiple owners. But partnership might not be the best choice. Maybe you should consider a company structure with different shareholders first before you consider a partnership, just like a partnership. Or you can potentially bring in a company structure to the partnership or trust structure to the partnership, yeah, before you use your individual ownership as one partner. That's actually riskier. Okay, then what's company best for? Medium to large businesses, high growth potential. Yeah, that means maybe when you are paying a lot of tax and then you want to provide more asset protection choices. Yeah, that's better for company. And then trust, asset protection, family wealth management. Yeah, when it's easier to incorporate tax planning, asset protection strategies, then you should consider a family trust structure. And potentially you might have a big family group inside Australia. You can utilize the related benefits of utilizing a trust as the main structure. All right, so that's everything I want to mention. So that's basically the 8 factors. Of course, in reality, there are more you need to consider. Yeah, because every factor we have listed here there could be another 8 or 10 factors, little factors, sub factors you have to consider. So we normally strongly recommend before you register business, before you even consider registering a business, talk to us first. Don't just dive in. Yeah, there are many different occasions when a client come to us and mention that they want to register a company. Then after talking to us, we found out that trust is actually a better structure for them. Or occasionally they come in to register trust because occasionally people mention, oh, one of my friends told me it's a best structure. And then when we look at their personal circumstances, it's actually not the best, then they actually change to a company structure once they understand what they really want to do with the business structure. So it's really important, super important to talk to an experienced tax planner first before you register the business. All right, that's everything I want to mention. So here is a brief introduction about myself and also our contact details. If you have any questions and you are planning to register a business, talk to us first. Okay, thank you very much. We'll talk to you in our next session.